Hey guys, it's that Dividend guy coming at you with another Robinhood portfolio update. Happy Thursday. Hopefully everybody's having a GGD, a great green day in the market. You know, always just the best for my viewers and subscribers. So for today, we are going to look at the overall portfolio value. Of course, the value by the metrics, see how we've been doing over time, the buying power and where money's coming from for the rest of the month, as well as our individual holdings, how they are performing and seeing if there are any deals, if there are any stocks that are overpriced or in our buying range. We'll take a look at those. And then, of course, we're going to take a look at the watch list at the very end and see if there are any deals. And it looks like Costco might be down. So let's jump right in. For today, we're up $38, so pretty much break even. We were up quite a bit at the beginning of the day, but it dropped a little bit. But it's been up and down for the past couple of weeks, so I'm not worried about it. That 1 week mark, we're up $245 with a 0.5% return. That 1 month mark, we're up $2,000 with a near 4% return. That 3 month mark, we're up $4,800, almost a 10% return. Year to date, we are up 11% with a $5,600 overall return in the green. Then that 1 year mark, we're up $11,400 with a 26.4% return. And then all time since April of 2018, we are up nearly $29,000 with a 111% return. So we're not doing too bad, guys. Overall, I'm happy with the portfolio. It's a lot of green. Of course, there are going to be market fluctuations. There are going to be times where we don't make as much money, where the portfolio is not in the green. And keep in mind, I prefer red days or even days, because that means that there are deals within the portfolio. It's great to be making money. It's awesome to see, all the stocks green and everything is up, but that means that I have nowhere to allocate my capital. So I would rather be down than up, because then you get larger returns because you get a lower stock price, which means you get stock appreciation. And then on top of that, you get a higher dividend yield, which is what we're really after with these stocks. The appreciation is just a cherry on top. The dividend is what I'm going after. So getting that double punch, that double 1-2, is getting that stock appreciation plus getting that dividend growth on top of that appreciation. That's where the real big returns come into play. So as of right now, our buying power is sitting at $99. It will be going up to $100 because we have a dividend coming in from Google, and of course a dividend coming in from Realty Income here soon. That will put us above that $100 mark. As of right now, I'm probably going to put in $120 to $130, enough to buy at least a share of Google or a share of Apple, depending on which one is a better deal. As of right now, for the course of the week, Google's been a better deal, but we'll see when we jump down into the actual stock. So jumping in, Realty Income Dividend Aristocrat sitting at $56.22, 5 shares, $280 of market value. Average cost is around $52 per share. 0.5% of the portfolio is in Realty Income. Today we are down around 80 cents. Total, we're up $22 with an 8.62% return and a dividend coming in a few days of $1.34, which will push us past that $100 mark for free cash in the portfolio. Then I get paid tomorrow, so probably over the weekend I'll allocate a little bit of capital and be able to buy either a share of Google or a share of Apple, depending on which one's a better deal. But with this overall position, I look at this as my retirement fund, essentially. Realty Income is just going to be that steady Eddie dividend payer. I don't plan on selling it again in my lifetime unless something economically changes with the business or there's a massive dividend cut. But historically, they've had really good occupancy rates, nothing below like 93 to 90%, I believe. And they've grown the dividend for over two and a half decades now. So I'm not worried about longevity. Real estate's always going to be there. The buildings are always going to be there. Some of their tenants do worry me a bit. They have a couple of like dollar stores, and of course Walgreens is one of their biggest tenants, which I know they are closing a lot of stores, so I don't know how that's going to impact Realty Income. But all in all, they still own the real estate properties. They're under triple net lease, which means that they don't pay any of the taxes, utilities, maintenance on the building, anything like that. They just collect the rent check. They essentially do what McDonald's does, and they own the land. So I'm not worried about an individual tenant being too big of a portion of the portfolio because of how their rent is set up and how their leases are set up. So even if Walgreens isn't sitting on that land anymore, somebody else will take that position, and it'll be a different, more diversified portfolio overall if Walgreens does move out of those spots. So overall, guys, I do want to get Realty Income back up to that 10K position. But as of right now, I'm more focused on companies like Google and Visa, where that dividend growth and that stock appreciation, just overall business, I think is better. But once Realty Income gets closer to my average cost, I will be purchasing it more. I just don't want to pay a near 10% markup for the company, especially after for the past year and a half, they've been trading nowhere, and they've been below around that $50 mark. So that's where I want to add more shares. Next up, we've got Altria sitting at near $59 per share, 320 shares, $18,000 of market value. Average cost is $47.27. 34% of the portfolio is in Realty Income. Excuse me, is in Altria. It happens, guys. Today we're up $216. Total, we are up almost $3,600 with a near 24% return. Guys, I'm not buying any here. This does its job well. Altria's main purpose in the portfolio is to forever, that's the underlined big thing there, is forever buy me a share of Apple. And as long as Apple stays below $320 per share, I'll keep bumping up this position in Altria to match whatever, stock price Apple goes to. But as of right now, it buys me a share of Apple for life with a little bit of extra cash. So it's doing its job well. It's helping me build my Apple position, as well as now I'm able to add a bit of free cash to the portfolio, so now I can buy a little bit more if I want to. So overall, guys, I don't plan on adding to this position, especially at these levels, but if it drops closer to my average cost, or if Apple's stock price, goes to $280 or something, I will add more to Altria just so I can safely buy a share of Apple with this dividend for the rest of my life, essentially. Next up, we've got Coca-Cola sitting around $70 per share. 15 shares of this Dividend King, one of my personal favorites, around $1,050 to $40 of market value. Average cost is $60.54. Around 2% of the portfolio is in Coca-Cola. Today we're down $7.88. Total, we are up $133 with a near 15% return. Guys, I don't understand why this stock is going up so much. Yes, I understand the brand. I understand the fundamentals of the business. I understand the economics. But I don't understand what is making Coca-Cola trade 15% up with a lot of other market leaders in different sectors going down. I do think this is one of those steady Eddie companies. People are going to buy Coca-Cola regardless. It's a great brand. It's a world-renowned brand. It's a loved brand. So I love the company. I want to buy more. I just don't want to buy it at $70 per share. I want to get it at 61 to 63. So as of right now, it's out of my buy range, but I will be patient and I'll try to take advantage of the next time it dips. Next up, we got Apple down big today at $211, so definitely a buy for me here. 10 shares, $2,100 of market value. Average cost is right around $220 per share, so this is the first time in a while that it has been at or near my average cost. Around 4% of the portfolio is in Apple. Today we're down about $60. Total, we're down $70 with a 3.5% loss. Not a huge loss here, guys, but a good cost down average opportunity. So with dividends and free cash, I might be putting money into Apple. We will see. As of right now, I still think Google is probably the better deal, but I am not going to lie to you. I want to buy a share of Apple every month, so I owe it to myself to either buy it this check or next check. Either way, I'm buying a share of Apple. So as of right now, I can't say whether or not, next paycheck would be a better deal. So I might allocate the capital to Apple here. Next up, we got AbbVie at $212.07. We've got 95 shares, $20K worth of market value. Average cost is right around $95 per share. Around 37%, or almost a fourth of my money now, is in AbbVie. Today we're up $2. Total, we're up $11K with a 122% return. Guys, this originally was a $9,000 position. So this is in the same vein or same position size originally as what Visa is today. Actually, Visa is a little bit more than what AbbVie was originally. It started out as, I think, $9,000 total, and it has grown, appreciated, and dividend growth has also helped as well. But overall, it's been such a great position, over 120% return, so I've more than doubled my money. So I have more gains than I do in the stock. So if this was a poker game, I'd be definitely taking my chips off the table and letting it run. But since it's a stock, I'm going to keep letting it run. I feel like this is going to be one of the most blessed fruit bears in the entirety of my garden when it comes to my portfolio. So AbbVie is one of those that I would love to add more of, but especially not at these prices. I mean, I'm going to let my money sit and keep growing. If something fundamentally changes, if there's a huge dividend cut, if leadership changes to a leader I don't believe in long term, something like that, if something fundamentally changes with this business, I will be taking my money out. I'll still leave the gains in AbbVie, but I probably would take my money out, so about 10 grand out of the position. So I'd make it 50-50. I'd take 10 out and I'd leave 10 in, and I'd probably put that towards Apple just so the money stays allocated at the same month. And yes, the dividend income would go down substantially, but if something happened, that's what I would do. But as of right now, guys, I don't see that happening for the foreseeable future, so I'm going to let it keep sitting, keep growing. The worst thing that you can do as an investor, especially when you're doing individual stocks, is cut down your fruit bears, your trees. This is something I see happen a lot. And it honestly, it shoots investors in the foot. It stops their growth. Like, I wouldn't cut out AbbVie to put it into something else like Coca-Cola or even Apple at this point, because according to my growth rate, AbbVie's actually outpaced Apple as long as I've held it. I'm in the green more than what I would have been with Apple. So especially when you put in the dividend. So overall, guys, this is just going to be one that I kind of set it and forget it. If it drops close to my average, I'll buy more. But as of right now, I'm just going to keep letting the position grow, letting the dividend grow. And with this dividend of about $60 per share, $160 for the position for the quarter, I will go ahead and just buy a share of Google. So this does what Altria does for me. Altria buys Apple, AbbVie buys Google, and then with extra cash and the dividends from a third set of months, I could buy something like Altria, Realty, or Coca-Cola. So that's the main strategy, is this month pays for next month. So even though I'm not adding to AbbVie, it's still doing exactly what it's supposed to be doing. So, and I don't, like I said, I don't plan on selling it. This is going to be, just statistically, this is going to be the stock that makes me a millionaire. Next up, we got Visa down to $3.29. Wow, it's a nice drop. So it's in the red. So right now, as of today, Apple and Visa, and I'm pretty sure Google too. Google's been getting slammed. All three of these are going to be buys for me still, which is awesome. So we have 35 shares of this high-quality company. Visa's honestly, I think it's actually, overall, I think it's a better company than Apple, because this is kind of a set it and forget it as well. They own a payment processing network. That's how they make their money. They don't issue cards. They are advertised on cards because cards use their payment network. Banks use their payment network for transactions to pretty much get money from one place to another. And Visa is the sponsored network, as is MasterCard. So it's a little bit different business than Discover, Capital One, or even American Express is a little bit different. But MasterCard and Visa are very close together. I like Visa better just because I understood the business better, and they're less international. But I mean, that could be a good thing for MasterCard. So overall, guys, I love the business. As of today, we have 35 shares, $11,500 of market value. Average cost is $3.47, so almost $20 down per share here. 21% of the portfolio is in Visa. Today, we're down $112. Total, we're down $600 with a 5% loss. Guys, this is a great buying opportunity for me within the portfolio. I would add to the position if I knew where stock prices were going to be on my next check, but I might just bite the bullet, buy a little bit early, sorry guys, bite the bullet and buy stock before my second check. But we'll see where Apple and Google are at comparatively. Next up, we got Google at $164 per share, down $4. So as of right now, they're down about the same amount. 15% for Google and 5% for Visa. But since it's a bigger position, Visa's down more. But as of right now, I still think Alphabet or Google is a better buy. So sitting at $164.29, 6 shares right now, around $900, almost $1,000 of market value. $193 per share, 1.8% of the portfolios in Google. Today we're down $28. Total, we're down $174 with a 15% loss. So still Google is the better buy. And, sorry, notifications. But I still would put money into Google. So, and we have a dividend coming in on the 17th of $1.20. So, a dividend paying company. I don't know how much it's going to grow. It's obviously a very new dividend, but I do love Google. So, as of today, guys, I'm going to be buying Google with this check. Probably Apple with the next one. Now, for the watch list, as of right now, Costco's definitely a buy, guys. It has dropped like a rock. 177, a 16% loss in the past month. Year to date, though, it's pretty much break even. So if you bought it at the beginning of the year, you haven't really lost out on anything. So that's good. Over the course of the year and 5-year mark, of course, and max, it's of course a steady Eddie grower. So I mean, right now, Costco, if I had $1,000 of free cash, I probably would add at this point, but between the 52-week low and high, it's like 600 to 1,000. So this is pretty much right in the middle. So which is probably a good. I mean, for me, that's fine. That's a fine place to start a position. So as of right now, if I had $1,000 that I wanted to put in the market, I would probably consider Costco. I still would probably put more money into Google right now than Costco because I think Costco is still going to drop a bit. So I don't want to jump in too early. And Costco is going to be one of the last companies, probably the last one that I add to the portfolio, simply because I'm focused on Apple, Google, and Visa right now. And then, of course, at Berkshire, being at 500, I'd still buy it here. I want the insurance float. I want BSNF. I want the railway. I want See's Candy and Borsheims. Those two companies, See's Candy, Borsheims, and Dairy Queen are the main reasons with the insurance float that I want the company. Because just for me, the insulation around the insurance business is in the class, the amount of brain power at Berkshire when it comes to underwriting with Ajit Jain and just everybody that they've acquired over the years, I think outpaces everyone else. So I think that there's two big reasons why I want them. One, they have some of the best insurance writers in the entire world, for one. Two, they have actual businesses outside of insurance that can help insulate them from big losses and help with the cash flow. Three, they have Buffett or Berkshire's portfolio, their actual individual holdings, and that also insulates them from big losses. And they also underwrite very well. So over the course of time, they've had a very good double-digit underwriting, which means that they've accurately predicted the future when it comes to claims, and they haven't had very many big losses, which with a regular insurance company, guys, a huge loss can bankrupt the company. So Berkshire has a lot of cash on the side, so they are ready for a big drop in the stock market or for a big drop when it comes to claims. They have insulation between their actual businesses that they accrue cash from every year, as well as their stock portfolio that they get dividends and growth from. So, and they make money on underwriting. So most of the time an insurance company, even if they have losses, as long as their investment income is in the premiums that they make are invested and that leftover money outpaces the amount that they pay out, they make money. Right, that you don't have to worry about them losing money. And some quarters, insurance companies lose money, and it's okay. They still stay afloat. But it's the huge losses that can bankrupt them. So that's why I like Berkshire, because I don't see them underwriting in a way that's going to bankrupt the company. And even if they make a big mistake, which again, they have class act people running their business when it comes to insurance, I'm not worried about it, but say they do underwrite poorly for a year or two, they have insulation with actual businesses and their portfolio, so I'm not worried about it. That's the big difference between Berkshire and something like Chubb or Travelers or Aflac. I've owned, I think, all of those companies, but the big difference is I got too nervous about having to look at the total complete ratio, the combined ratio, and when the investment income didn't outpace the losses, it made me nervous, and I don't feel like I'm going to have that anxiety about owning Berkshire because of the other income streams. So for me, I love insurance. I understand insurance. It's just I feel like an individual insurance company is a bit too risky for me personally, even though I understand how they work, and a lot of them are very profitable. They make a lot of money, but it makes me uneasy a little bit. So I'd rather just own Berkshire. And so I'll buy it eventually. I actually got money for Christmas to buy a share of Berkshire, and I haven't done it yet. So I'm waiting. I'm being a good noodle, leaving it in my savings account, trying to make better money decisions than just pouring money into the stock market. So, but with that being said, guys, thank you so much for watching. Remember to hit the like button on the video if you enjoy the portfolio updates. Also, hit the subscribe button, guys. We have nearly 1,400 subscribers now. We're growing every single day. I hope if you guys enjoy the daily grind, enjoy me being completely transparent with my portfolio, that you subscribe. I plan on doing this every single weekday, and then on the weekends I'm going to try to get some more shorts out for you guys as well. So I'm trying to be as consistent as possible, and if you do enjoy the content and enjoy the grind and enjoy the growth of the portfolio, hit the like button and subscribe. I'll see you guys tomorrow with the last Robinhood portfolio update for the week. Take care, guys.